Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, like I normally do. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's just dive right in, take a look, and see what's going on today. If you want to follow me, it's @_finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, subjects, looking for potential investment opportunities and sharing them with everyone in the community. We do have a special going on. Special is the coupon code if you'd like to join. It's 50% off the first month only on a monthly membership, and a larger discount on the yearly membership. So starting off with Lawrence, he says, Speaker Johnson warning, you guys are smoking in the dynamite shed. And this is the U.S. 30-year bond yield breakout on the quarterly. And this is going all the way back into, this is 90s, 80s, and this is early 80s on the left there. So early 80s all the way down. You can see the trend line break to the upside. And now we're breaking another support resistance area in that circle. This definitely looks like a trend reversal to me. And when interest rates go up, that generally moves money differently than it did before. Let me describe that real quick so you guys have an understanding of what I mean by that. Financial assets are priced based off of yields. The 10-year yield is what basically they use. This is just the 30-year. The 10-year is doing something basically the same as the 30-year. They use that in discounted cash flow models for net present value calculations for stocks and other financial assets. As yields go up, the net present value calculation declines. So when interest rates go down, like we saw in the past 40 years, money piles into financial assets. As this breaks and goes back up, that changes the dynamics of the money flows in the system. Money flows from one asset to a different asset. And the reason it flows is as interest rates go up, people prefer to put money into bonds, say, over the stock market. Because if the risk-free rate of return in bonds, and I'm not saying it's risk-free anymore, but most people use that as the risk-free rate of return, the interest rate on the 10-year yield. People would prefer to go into bonds over stocks. Now, if interest rates continue to go up and the stock market rolls over, that will inflict pain into those that own the stock market. Money under these conditions typically rotates into precious metals and commodities. As money rotates into precious metals and commodities, they get positive returns, and then the stock market and bond market will both have negative returns. So it is people being forced out of bonds and stocks, which we call financial assets, and it rotates into hard assets like precious metals and other commodities like uranium, oil, coal. It doesn't matter, whatever it is. So that's kind of why this is such a big deal. It spurs money rotation in the system. Smart Real Estate Bet says those are all fair points, but home buyers also need to get over the fact that the generational lows in ownership costs from 2009 to 2020 are gone, and they are not coming back anytime soon. Home affordability right now is better than it was from the late 70s through all of the 80s, and not far off from where it was in the 1990s. They should also pay more attention to the fact that they spend more of their income on rent than any preceding generations did. And just because they are accustomed to it does not change that fact. Buying my first home in 1996 required some sacrifice, but a whole lot less than when my older brother did in 1983. And here is the house affordability based on median family income. Affordability is worse the higher you get. The worst affordability was in the 1980s, early 1980s, when interest rates were quite high. We went into a decline of interest rates over that past 40 years. Remember that 30-year interest rate chart we were looking at above? This is the same thing for mortgage rates. Mortgage rates fell, and we hit a low with both home prices being cheap after 2008, and on top of it, interest rates were also cheap. This was one of the most affordable times in history to purchase a home when looking back in history. Everyone is comparing where we're at today to the most affordable time in history and saying, well, it was cheaper back in 2010, 11, 12, 17, 19, 2020, and so forth. Well, what he's saying is that's probably not coming back. So I think what's going to occur, and I think this is what he's also saying, is that the mindset will shift when people realize, hey, look, I don't think interest rates are ever going back down to 3%. So they change it and they say, you know what, I'm just going to have to bite the bullet and buy a house. At higher interest rates, I would pay the mortgage down quicker, or I would also take and loan less money out. I'd put a larger down payment down if it were me. And that's just a function of the interest rate and how much interest I would be paying on that loan. But yes, I purchased a home in this box here, over in this section over here. Oh, and here's some more stuff here. Rent affordability based on median family income. It's way up there in comparison to 1970s. Remember, 1970s, it was expensive to buy a house in 1980, late 70s. But rent was not that expensive. Now, rent is very expensive, but it's also expensive to buy a home. And then own versus rent affordability, 1971 to 2022. Relative affordability versus rent. Here it was expensive here to own a home versus rent. Right now, we're kind of in the average spot for owning versus rent. It's still not super expensive to own in relationship to rent given history. So that's kind of the data that I wanted to show there. Wells Fargo expects a 2026 a bullish year for energy as growth picks up. And I don't, in all honesty, guys, I don't really care what Wells Fargo. I mean, I just share things that people are sharing on Twitter, and in fact, most things I already know most of this. I mean, it's not like any of this is new. The question then becomes, okay, if 2026 is going to be bullish and people start positioning, that means 2025 will be a bottom, most likely, somewhere. And no one can catch the bottom perfectly. But, I mean, I'd be a buyer all throughout because oil and energy in general is dirt cheap. Dirt cheap. And I think if you look back 5 or 10 years, you're going to look back and say, oh my God, what was I thinking back then? At least I hope that's the case, because I'm positioning in all these things that are incredibly cheap here in commodities. And I think I'm going to look back and say, thank God I loaded up when I did. Thank God I loaded up when I did. So gold is more likely to break up than break down when using the sentiment indicator below. And he's talking about gold miners' bullish percent index. And you can see on the relative strength indicator that it is oversold. And it's going up for the Van Eck Vectors Gold Miners ETF. And this is Gold Miners' bullish percent index. We're kind of towards the middle for that one there. The goal of the admin was to bring in Doge to reduce the deficit. So they are now passing a bill to add $4 trillion to the deficit. That does seem interesting. That's all I'm going to say. It does seem interesting that is going on. The trading initiative. So rates have broken out of the 40-year downtrend. If this were a stock, we'd call it a stage 2 uptrend. And like any new trend, higher highs attract sellers who aren't convinced, leading to weaker auctions, hesitant capital, and more volatility along the way. Get used to it. So get used to higher rates. And again, higher rates puts pressure on financial assets, specifically bonds, because bonds sell off when rates go up. That's how rates go up. And financial assets being the S&P 500, NASDAQ, and a lot of these, they particularly impact growth stocks the most. Growth stocks rely on future growth for their net present value calculation. The more earnings in the future that you have that get discounted back to today with higher interest rates impacts the net present value more dramatically. And what generally happens is you get a twofold whammy here. You get interest rates going up, so people are like, well, I don't want to speculate on something if I can get an 8% return in bonds or whatever the percentage is at that time. Another thing is this previous bear market in bonds, or I should say bull market in bonds price, bear market in yields, that pushed all the money into financial assets. So the financial assets are overpriced. So as interest rates go up, they're not only just overpriced, but all the net present value calculations are going down. It's going in the opposite direction. So it takes a long time for this to kind of work its way out. And especially after a 40-year decline of interest rates. This one's 30 years of lower rates. So I think it's going to take time for stocks to probably grow their earnings and grind sideways, correcting the price to earnings ratio. Jeff says, bullish China chart with Japan's bond market sell-off. Just 13 bips separates China's 10-year government bond yield from the bond yield on 10-year Japanese government bonds. In 2008, when China's bond yields became very close to Japan's, Chinese stocks strongly outperformed until late 2009. Prior to that, the mid 1% range on the bond yield difference, or differential, between China and Japan also coincided with China's multi-year stock market run at the beginning of this century. The November 2008 extreme was revisited in April 15th, 2024. That also coincided with China's outperformance over the last 13 months. With this sharp sell-off in Japanese bonds, which is sending its yields sharply higher, the China minus Japan differential could soon go negative. This is profoundly bullish for Chinese stocks, in his opinion. And this is China's yield convergence with Japanese helps Chinese stocks. There's another thing I want you guys to pay attention to here. The bull market was the bottom of 2000-ish, 99, 2000, all through here. We had a big surge in the China divided by MSCI Japan ratio. We have another kind of, if you look at this pattern here, it's an ABC correction, which is known in Elliott wave, I think it's called a running flat. And I think this is ready to rip and create first wave here, second wave pullback, and this is the beginning of the third wave up move. I think China's going to rip. It's going to rip. I also think commodities are going to rip. But be careful. I know USA and China, there's some friction there. And I don't want my stocks to be taken away like the Russian stocks. Remember that? Hopefully we get those back. So, James Henry Anderson says, NYMEX Platinum is now being pulled harder versus back post-2020 COVID suckage. Mostly went to China. So how tiny is the current underlying 410,000 ounce CME Group's COMEX NYMEX pile? So that's what they've got in COMEX, only 410,000 ounces. Chinese platinum import demand last month alone was 371.3 thousand ounces. Gold investors thrifting too. So Chinese platinum imports are up quite a bit there in terms of tons. And we don't have a ton of stockpile in the COMEX. This is going to get interesting. It's going to get so interesting, guys. I love it. I love it. This one is WTIC, West Texas Intermediate Crude. What we've got here is now from a different perspective, we can see the bullish potential. And this is the flag pattern that I am most accustomed to. This pattern here is very similar to the pattern that we see here. It's similar to that. It's a consolidation between wave 1, where he's got the little 1 there, and then wave 2. Now, are we completely bottomed? Tough to say. But it is a flag pattern. I do think it's the end of wave 2 coming up at some point here. And then we'll see wave 3, which he has way up here. That's what comes next. That's exactly what I see. This here is the cycle. This entire thing is one big Elliott wave cycle. We are not in a consolidation or a pullback. The consolidation started in 2008 and it ended in 2020. Now, I hear a lot of people, oh, we're in this huge bear market. Well, the way that I define it is a bull market is where the Elliott wave is in an advancing move. The advancing move, we had wave 1 was the 1970s advancing move. We had a big consolidation with a long decline of interest rates. This one basically here. So this was wave 1, wave 2, and then wave 3 is going to come. And it's not going to be for interest rates. Interest rates may not move as big, but if you look at other commodity charts, you've got a big consolidation that occurs between wave 1 and 2. It's a running flat correction. And we're at the beginning, potentially, of wave 3 and at the end of wave 2. Hopefully that doesn't get you guys confused, but it deals with interest rates being the driver of that. And this is what's driving money flows from financial assets to hard assets. Wave 1 was this guy here when interest rates went up. Wave 2 was the pullback in interest rates where money flowed back into financial assets. Wave 3 is where we get a money flow back into commodities, which will drive them to much higher levels than what we did in the 1970s. Platinum's breaking out of a 15-year base. Last time it broke a similar pattern, it ripped up 475% in 9 years. With volatility near record lows, this move could be explosive. Look at the Bollinger Band. You can see these kind of squeeze up, and then they blow out to the upside when it hits. We have another squeeze up here, very low, where we could blow to the upside. For platinum, I'm guessing platinum could easily go $4,000 or more. Tavi says 3 key takeaways from the UBS's latest family office strategic allocation. They have less than 1% in commodities, 1% in emerging market equities, and 2% in gold, precious metals. These 3 allocations are very likely to grow meaningfully by the end of the decade, in my view. And this is what makes a bull market and money flow shifting from financial US-based assets into commodities, emerging markets, and gold, precious metals. He's 100% right. 100%. Cycle bottom, the USD breakdown is a key plank to our commodity bull market thesis through 2027. Totally agree. And rock bottom says the US dollar has failed to recover from its breakdown. $97 test is on deck. Once broken, we enter a golden age of commodity investing. Completely true. And that deals with interest rates as well. Interest rates, the relative strength or weakness of the dollar, and money flowing from a strong to weaker currency flowing into a weak to stronger currency. This is the piece of art gold and log chart. And again, big move up from 2000 to consolidation, and we've broken that out of that consolidation. This is clear as day, guys. Clear as day that this is a breakout of that consolidation. And gold's our leader for commodities. Bond market starting to realize that nothing stops this train. It says what we are learning is that there will be no material fiscal consolidation. The U.S. will continue to run extremely large deficits as far as the eye can see. They have to in order for the system to survive, the currency. and the way it's designed. Palladium is now moving higher from its bear market base. One of the best looking big picture charts there is right now. Are you ready to rip your face off the bull market for Palladium? Another 2,118% move up, this time starting at 800, would mean that the target is at $17,000 an ounce. Third wave, another 2,118%. 40-year parabolic base indicating a huge move is coming. And again, that's tied to what it's being priced in, the dollar. And here's platinum. Platinum is now breaking out hugely. Been saying lately that platinum is now seriously thinking about going for the mega blue breakout. And now it is doing just that. The secular bull market for platinum is about to resume. And consider that Russia, China, and Iran are now stacking silver and platinum. And Russia is looking at banning export of palladium and platinum. And South Africa is still not stable, which could drive price that too. Just like silver was, platinum was sitting right below a historical huge blue breakout line. It has been in a cyclical bear market for 17 years and is now breaking out and resuming its secular bull market. A generational breakout and opportunity is here also for platinum. Platinum has now been basing out for about 10 years, just like back before the start of the secular bull market back in 1990s. The blue breakout will confirm the resumption of the secular bull market for also platinum. And the blue breakout will also confirm that wave 3 has started, which is the strongest and most profitable phase. Platinum has a very, very long way to go. The posted ratio chart looks fantastic. What the exact final target price will be is not so important right now. What is important is to get ready and to get the guidance. Even before I called the commodities bear market low back in 2020 in real time, I said platinum will outperform gold and silver in the coming bull market, pioneering platinum case on FinTwit. Many will now wake up to platinum and palladium, but go with us. I've played these sectors for decades. So this is platinum 45-year chart, just starting to break out. What he says is this is a generational breakout opportunity. We've got a bullish MACD crossing its zero. We've got a breakout of a declining trend line. We've got a very large consolidation. And generally, when you break these large consolidations, they tend to run for a long time. So our opportunity is here right now. Watch Saudi crude exports. It will tell you everything you need to know about their oil policy. And right now, they're kind of chopping sideways. Let's watch this as time goes on. Eric Ewan says, only after devaluing the USD 75% throughout the entire 1970s did Paul Volcker take the Fed funds rate to 20%. This means the debt was devalued more than 50% by 1980. Think about this for a second. The sequence of events matter. So they let the dollar devalue 75% through the entire 70s. And that also meant that the debt was devalued more than 50%. That's what happens first. Then they raise rates after that. The sequence matters. And what's going to take off are going to be commodities and precious metals. That's exactly what we're seeing in all these big breakouts. These are all interconnected. Everything here that I talk about is all interconnected. All of it. Money rotation, money from financial assets to hard assets, the increase of interest rates, the printing of money, the inflating the debts away. Chris says the same thing happened in Argentina. They had a horrendous inflation for years, and now they can afford to have Milei cut things. Doge was never going to work in the U.S. until after we have our inflationary period. The debts have to be devalued first. Correct. Nothing stops this train. And that's where we're going to end it, guys. So give me a thumb up for this content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for today. So we'll see you next time. This is Finding Value.